While you're earning 7 to 10% in your stock and index fund investments, the ultra wealthy are earning 15 to 25% in private equity investments. By the end of this video, you're going to understand why they're doing it and why you should be too. Hello, I'm Christopher Nelson, and today I want to explain to you what private equity is, what are its benefits, what are its risks, and why you should consider investing in it. Private equity has historically been an amazing asset to the ultra wealthy. I'm really surprised that even today, there's a lot of high earning tech professionals that don't consider or don't understand what private equity can do in their portfolios. Historically, private equity has produced higher returns over time. The reality is that private equity, because it's been private for so long and people weren't able to really talk about it and communicate about it, they still today don't understand. But because of regulatory changes in 2012, now we're able to have access to a lot more of these investments, but many of them are still misunderstood as far as the value they can bring and then also the risks that they can bear. So today I'm going to break down all of this for you so that you will understand more than 99% of the people out there. First, I'm going to dig into why private equity matters now. Private equity should matter to you. Private equity is the key to unlocking your lifestyle. If you look at the portfolios of ultra high net worth individuals, private equity can take up 45 or sometimes 60% of their allocation. That's exactly what I mirrored in my portfolio when I adopted a 50-50 methodology, and 50% of my portfolio is in private equity that's now replacing my paycheck, so I no longer have to work a W-2 job. That's why it's important to you right now. You may be asking, why haven't I heard about this? Well, you haven't heard about private equity because a lot of traditional advisors in the mainstream media are not talking about it. The reason that they're not talking about it is because they don't get incentive compensation to talk about it. It's in a totally different bucket, different than traditional investments. So if they're not incented in getting paid for telling you about it, they're not going to talk about it. So understanding private equity and how it can truly impact and change your life is really important. So let me explain for you simply, what is private equity? Private equity means that you are deploying capital or cash into the private markets. So to understand the private market, let me describe quickly what's the public market that we all know. The public market is the stock market, stocks being traded on the NASDAQ or the New York Stock Exchange. There's also the bond market. There's also certificates of deposit and cash. Those all fall under the umbrella of traditional investments, and they are also all under the purview of the SEC, the Security and Exchange Commission. It creates requirements that people have to adhere to so that their investments can be traded on these public markets. Public markets are also very liquid, and you understand their value because their value is publicly visible. They also have very strict auditing requirements as well. Everything that is outside the purview of the SEC is in the private market and is considered private equity. Private equity is an umbrella for a large amount of investments that can be everything from funds to private business holdings to real estate to owning royalties, many things. But it really just describes where you have money that is invested in a instrument or in some type of a asset that is outside the purview of the SEC, meaning the SEC does not audit it, and it has specific requirements that says if it meets those requirements, the SEC will leave it alone. And so what does this mean? It means that private equity is going to be private capital in private investments that the SEC is not going to have visibility to. So it's going to be illiquid, meaning that it's not going to have the flexibility of the public market where things are traded back and forth. It also means that there's going to be less transparency. The transparency is going to depend on who you're making the investment with. It also means there's going to be an opportunity for greater return and also greater risk. This is truly what private equity is. And the reality is, private equity has been around a lot longer than the public markets. If you think about it, private businesses have been in people creating businesses, establishing and growing them with shared amounts of capital, have been existing for thousands and thousands of years. For many of you, you may be asking yourself the question, why was it a few years ago I didn't see anything about private equity investments, and now it's all over my social feed everywhere? Well, the reason is there was a huge regulation change in 2012. Before 2012, all of private equity was truly private, meaning that if I had a private equity investment and I wanted to share it with you, I would have to document our first meeting, and then I could share it with you after I got to know you for 30 days. That's right. 30 days. There was this seasoning period where if I got to know you, I could share it with you. So in that day and age, pre-2012, private equity was really private. We didn't hear a lot about these different types of investments. Then in 2012, there was the passing of the Jobs Act. The Jobs Act, which stands for Jumpstart Our Business Startups Act of 2012, wrote in a regulation that said if a third party is going to verify that you are accredited, meaning you meet the net worth or you meet the income requirements to be able to invest in private equity, because there's a threshold to invest in private equity, then we can advertise it online. If your investment, make sure that you validate and verify through an independent third party that everybody is accredited. This then changed the game. Now you could have people advertising private equity investments on social media, online, in different places. This is what truly allowed private equity to appear everywhere. The unfortunate thing that came with that is then everybody started jumping into private equity once they started understanding what was the power of it. For you, it's just important to understand the history that private equity has been around for many, many years and is a well-established investment practice and philosophy that can be incredibly impactful for you. But the reason you're seeing about it is because of the changing of the Jobs Act. The key thing to understand is that private equity really belongs in your portfolio because it offers a lot of different features than traditional investments do. It has asymmetric returns. It provides cash flow. It also gives you a different level of diversification in non-correlated assets. So let me break that down. One of the key things that private equity investments provide is tremendous cash flow. Cash flow is being able to provide you checks monthly or quarterly from operational profits. This is something that you're not able to get out of the public equities market. But this cash flow is what allows you to replace your paycheck and unlock your lifestyle from your wealth. Number two is asymmetric returns. A lot of private equity companies have been out there executing for many, many years, and this truly allows them to know their business inside and out and be incredibly efficient, meaning that they can provide you these tremendous returns and reduce the risk because of their experience and because of the teams that they're able to bring to the table. The other thing is tax efficiency. Private equity investments, because the tax code provides a lot of incentives to them, especially real estate, you're able to get tremendous depreciation. Depreciation then offsets the same income that you get from these investments. So if you're receiving that income of $100,000 a year, but you also have $100,000 of depreciation, means that you pay no taxes. The key thing to understand about this special tax treatment is that it is a negative balance on your tax returns that you can carry over year after year. So if in one year you accrue twice as much depreciation as you need, whatever's left over, you bring it into the next year. This is completely different than what you get out of the traditional markets. So when you understand these benefits and you use them inside of your portfolio, this is when you get the tremendous wealth building capability that is private equity. For understanding private equity 101, it's important that you understand there's two main structures. Number one, a syndication. A syndication is where you create an LLC or a business around a single asset. A fund is where you create the same structure around multiple assets. Those are the two main flavors of investments that you're going to have when it comes to private equity. Are you investing in a syndication in a single asset? Or are you in a fund that is going to own and manage multiple assets? Now, both of them will have different rules and constructs that go with them, meaning that how many fees you pay in each one, that's going to be different by operator. What are the returns that are you going to get? That's going to be different by investment. All of these things, it's so important to understand. In a syndication, you're going to just have exposure to one asset in one market, which, depending on the scenario, could increase your risk or reduce it. A fund, depending on how it's managed, whether it's open-ended, closed-ended, is going to provide you the ability to diversify across multiple assets and maybe even geographies. But at the same time, it can also be more complicated in understanding what are the different assets or investors, how do they impact the finances of the funds. For you, it's important that when somebody is presenting you with a private equity investment, you understand to ask these fundamental questions of, is this a syndication? Is this a single asset? Is this multiple assets? What are the geographies? What are the terms of the funds? Are you continuing to raise capital? Or are you not? And understanding who the operators are going to be. In both of these constructs, syndication and fund, you're going to have general partners who are going to operate the funds, and they're going to get a certain set of fees and benefits from the investment. Then you're going to have limited partners. Limited partners are generally the investors. They're going to be the ones bringing the capital, but they're also going to have benefits that they're going to get from the investment. And they're also going to have different sets of rights. Understanding what those terms are and being able to ask questions about it is going to allow you to become more versed in these different types of investments. You can't talk about private equity and not talk about real estate. Real estate is the darling of private equity. And why is that? It's because with one investment, you can have up to 4 different ways that you can make money. So with real estate, that's cash flow, that's appreciation, that's the depreciation, the tax benefits, and then there's also the equity pay down, where through rent, somebody is actually paying you to own more of the building. Real estate dominates the conversation around private equity because of these 4 different attributes, and it's important that you understand that. Private equity investments, also known as alternative investments, because they're alternative to the traditional markets, encompass everything from mega billion-dollar funds by BlackRock that can raise $1 billion in a year to make investments. It ranges from that to, micro syndications where you have people raising a few $100,000 to buy a 10-unit apartment building. That is truly the scope of private equity from a size perspective. You can have billion-dollar funds to $100,000 syndications and everything in between. So you're going to hear about mega funds. You're going to hear about boutique funds or mid-market funds. Usually those are scoped by the different sizes of dollars that are going to be taking in to invest in the different asset classes. And that's something else. Private equity can invest in all different asset classes also. So it can be everything from buying skyscrapers, a single skyscraper, maybe buying a group of skyscrapers, or industrial buildings, or buying businesses. You hear about private equity funds that are rolling up different businesses, again, at different scale. The key thing for you to understand is when you start getting exposed to private equity is asking qualifying questions. Where people get very confused is they just let somebody stop on the term private equity and they say, I don't understand what that is. Well, here are some of the questions you can ask to get unstuck. Is this a private equity fund or a syndication? The person doesn't know, then you ask, is it investing in multiple assets or a single asset? Then it's, what is it investing in? Is it investing in real estate? Is it buying royalties? Is it a litigation fund? There's so many things that private equity can invest in. Understand what is the underlying asset that it's investing in. And then you start understanding, how big it is, how complicated it is, and if this is something that can really fit inside of your portfolio. Understanding the size and the scope of private equity is critical for you so that you can really understand your risk. Because the reality with private equity is, while it does provide phenomenal returns, there is tremendous risk associated with it. And this is why you need to understand what are the questions to ask. Being outside of the public market means that private equity does not have the same requirements for transparency as the public markets do. Public markets need to report audited financials every single quarter. Private equity does not have the same requirement. In public equity, you're able to see the value of the company, the share, what the market thinks the value is every single day on the public markets. That's not the same thing in private equity. So, transparency is number one. You need to ensure that you get clear on the financials. When you're regularly going to get to see and understand the financial statements from the actual investment and the team that you're investing with. Number two is operator risk. Operator and understanding who the operator risk is so important. If they are a brand new operator and they may not understand the space that well, there's going to be more inherent risk versus if you go to an established private equity company that has been in business for 15 or 20 years, continuing to produce great returns, that's going to reduce the risk. But there's operator risk as well. Illiquidity. This is different than a stock market investment where if you don't like it, even at a loss, you can extract your dollars from the market and get liquid and get out of the investment. Many of these investments have 3, 5, 10-year holds, or sometimes even longer. The other risk is high minimums. Some of them may have minimums. The average minimum is $50,000. It can be up to $250,000 and sometimes as low as $25,000. But having high minimums, being illiquid, having operator risk, and that transparency creates this veil of complication in making private equity something that's not accessible to you. The key thing to understand is like anything in life, if you try to understand the risk, you get clear on what the investment is, you can mitigate a lot of these. But a lot of these risks are something that many financial advisors like to exploit and keep you out of private equity. Many financial advisors do not recommend private equity because they don't understand the risk. They do not have the knowledge and they don't understand it. Their focus for their business is to participate in traditional investments. Private equity is outside the purview of the SEC. It's this whole other universe, as you've come to understand, and they don't want to understand it. That's why many financial advisors will not recommend it. They themselves see it as too risky. There's others that don't recommend it because there's no financial incentive. Imagine if you went to them and they are managing your assets for a fee for all of the assets they have under management, and you're going to take a quarter of that and you're going to invest it outside of the traditional markets in private equity where they don't get compensated. At that point, they lose an incentive to tell you about it. And for many of them, the licenses that they have are for the traditional markets. And again, they're not licensed to sell those things as well. So again, it goes back to knowledge and understanding. The truth is for you as an investor, as somebody who is a wealth manager of your wealth, a CEO of your portfolio, the question is, what do you want to do? The goal today was to give you a high level overview of what is private equity so that you can understand the fundamentals. And there you have it. Now you know what is private equity. You know the benefits, you know the risks, and you know some of the different types of structures. You know more than 99% of your friends on private equity. If you like more of this content, subscribe to Managing Tech Millions, where we teach you how to be the CEO of your portfolio.